But really, the misunderstanding regarding median return and capital market assumptions is that they are being used as predictions of the future. Certainly, GDP is not a useful way to predict the future of an economy, as demonstrated in the first part of my conversation here today. But neither are capital market assumptions. We do not predict the future. Return, what is risk? Risk and reward go hand in hand. There are two sides of the same coin. That is reality. That is how markets work. So if you're going to reduce the median return expectation in order to be conservative, do you not need to also reduce the volatility for that particular asset class in your calculations when you're running your simulations? Would that not be the appropriate thing to do? And is that? Welcome to the Moneyball Method podcast. Thank you for joining me. My name is Mark Shupe, and I'm the author of the book, The Moneyball Method, a Middle-Class Manifesto for Objective Investing. Today, I'm going to switch gears a little bit and talk about the practical application of economics and finance. My title for today's discussion is Gross Output and Moneyball Inputs. And what I'd like to start with is an opinion piece that appeared in the Wall Street Journal this week, and it was written by an economist by the name of Mark Shupe. Now, I'm not a big fan of macroeconomics and economic analysis as a way to help investors with their investment strategy decision, but this is different. Mark Shupe is unique, and his ideas regarding economics are valuable and relevant to what we do with the Moneyball Method. This Wall Street Journal opinion piece is dated September 28th, so it's only 3 days old. And I'd like to start with a sentence from the first paragraph. And I'm reading. Bureau of Economic Analysis revised upward its second quarter estimate of gross domestic product to show 3.8% growth in real terms, compared with a negative number in the first quarter. Think about that. How did we go from a negative number in the first quarter of 2025 to 3.8% growth in the second quarter? To me, that proves that the statistics from the Bureau of Economic Analysis are not very reliable. The economy did not change that much. And also, how was it possible that it was negative growth in the first quarter? According to the report, a lot of that can be attributed to heavy imports during the first quarter. Now, why would imports have a negative impact on the economic vitality of a company or a country? It should not. To be able to import goods and services from overseas is only evidence that the economy is doing well. But clearly, this is the result of businesses and consumers importing a great deal of goods. We're going to be subject to tariffs. They wanted to lock in lower prices. What does that prove? It proves that markets are responsive. They react quickly. They are efficient. But nonetheless, I think it also proves that GDP, gross domestic product, is not a reliable indicator of economic health. But what about that 3.8% number in the second quarter? Is that reliable? What does that tell us? What are the underlying factors that resulted in that? Moving to the second paragraph of Mark Shupe's article, buried in last week's BEA report is a much more reliable measure of the economy, gross output, or GO. What is gross output and how does it compare to GDP? And is it better? Is it more reliable? Is it more useful? Does it tell a better story? I argue emphatically yes. In fact, referring to chapter 3 in my book, page 78, and I'm going to read a very brief paragraph. Gross output is a method developed by economist Mark Shupe in the 1990s. It was adopted in 2014 by the US government as a quarterly indicator. As the first major development in national income accounting since the 1940s, gross output reveals the supply network to be double that of consumer spending. This fact is virtually unknown among the analyst community, yet it supports Say's law as a prime mover to sound economic theory. Now you understand why I took particular interest in Mark Shupe's opinion piece in this week's Wall Street Journal. Moving to the next paragraph, more important, overall business spending fell sharply by an annualized 5.6% in real terms. Now, if you are reading the headlines and notice that GDP was a strong 3.8% in the second quarter, you would not know that business spending had fallen sharply during the same quarter. That was revealed by the gross output indicators, but hidden by GDP. Why would business spending fall, and why does that matter to us? Well, clearly, it is the private sector that creates wealth. It is the private sector that pays for everything. And when the private sector is reducing their spending, it means they're cutting back on inventory. It means they are responding to something that is happening within the global economy. To further quote Mark Skousen's opinion piece, business is pulling in its horns, largely due to higher tariffs and the uncertainty of a trade war. That's important. The difference between the private sector and the public sector is the private sector entrepreneurs and business managers think long term. Government bureaucrats do not. Uncertainty forces them to think short term, to become pragmatic, to deal with the force of government, whether it be regulations or taxes or tariffs. And this creates inefficiency. This paralyzes supply networks. And this has a negative impact on the vitality of an economy. But Mark Skousen talks about something else that's even bigger, the 800-pound gorilla in the room regarding GDP. The idea that consumption is 2/3 of the economy is one of the great myths in economics. We are not a consumer-driven economy. Even though consumer spending, including government spending, is 70% of GDP, that does not tell the whole story. According to GO, gross output, what happens on the private sector and the supply networks accounts for 2/3 of economic activity. Moving to the next paragraph, Mark Skousen confirms it leaves out the value of the supply chain, which is bigger than GDP itself. Business spending is almost twice as big and more volatile, and it is a leading indicator. What is a leading indicator? These are things that happen within the economic data that suggest that things are changing. They happen in advance of a recession or a boom, as the case may be, as opposed to a lagging indicator, which are statistics that happen after the fact. I think this is important because as investors and advisors, the vast majority, if not nearly everyone, relies on GDP and statistics from the government to try to understand what's happening in the economy, to try to understand what's happening in financial markets, to try to navigate those to make financial decisions, investment strategy decisions that are in your best interest and help you live the one life you have with confidence. But what if your advisor is using data, using statistics, using information that is not reliable? It really doesn't matter if they ignore all of the macroeconomic nonsense anyway. What if they're relying on more microeconomic information? What if they are using statistics? What if they are using objective data? And here I want to switch gears to a conversation I had several months ago with an advisory team, a two-person team, interested in learning more about capital market assumptions, random simulations, and the investment strategy decision to help their clients. The conversation started with trying to establish a baseline understanding with how the economy really works and how it affects financial markets. So I asked, do you understand the efficient market hypothesis? Can you explain it to me, how do you explain it to clients? They had a vague understanding. They had heard of the term. They did not know what it was. The efficient market hypothesis has to do with the price mechanism of efficient markets. My next question was modern portfolio theory. Can you explain that? Do you understand how it works? What if a client had asked you about that? They were familiar with the term, but they really couldn't explain the details of it. And it has to do with the efficient frontier. Where are you as an investor going to get the maximum return for any given level of risk over the long run? The third question I asked had to do with capital market assumptions. And this was the purpose of the meeting in the first place. What capital market assumptions are they using? How do they work? Why did they select those? So I asked them, what are they? How do they work? And they weren't really sure. Capital market assumptions are the median return of each individual asset class, the standard deviation, which is a measure of the risk or volatility of that asset class, and the correlation, how they respond to each other in order to create a diversified portfolio. But this led to the next question. Median return, one of the three attributes of an asset class, one of its defining characteristics, one of the capital market assumptions. How is it typically used within the investment advice industry, and is it being used properly? And I went on to explain that almost universally, they are not being used properly. As discussed in previous podcasts, forward-looking assumptions replace the historical data sets. Conservative assumptions have replaced the historical data sets, or even worse, deterministic or constant rate of return assumptions are being used. But really, the misunderstanding regarding median return and capital market assumptions is that they are being used as predictions of the future. Certainly, GDP is not a useful way to predict the future of an economy, as demonstrated in the first part of my conversation here today. But neither are capital market assumptions. We do not predict the future. Our goal is to try to anticipate the possibility of extreme market events, calculate their impact on your spending capacity and your risk capacity, and have a contingency plan. Another aspect of capital market assumptions is correlation. How do they interact with each other? How do we use correlation? How do we use that data in order to construct an investment portfolio, make a strategy recommendation that is in the best interest of the clients? They couldn't answer that question. Getting a little more technical, what is the relationship between median return and standard deviation? One is return, one is risk. Risk and reward go hand in hand. They are two sides of the same coin. That is reality. That is how markets work. So if you're going to reduce the median return expectation in order to be conservative, do you not need to also reduce the volatility for that particular asset class in your calculations when you're running simulations? Would that not be the appropriate thing to do? And is that professional? Is that reliable? Does, in fact, the risk of an asset class go down just because you're reducing the expected return? And this brings up a very important point. What is more reliable than the long-term historical data sets? Someone's opinion about the future using GDP as a forecasting tool? I don't think so. The last thing we discussed was rolling returns versus calendar year returns. It's very common, easy, and somewhat useful to use calendar year returns to illustrate market cycles, how things change over time. People understand calendar year returns, but they are limited in their usefulness, in their ability to explain the dynamics of capital markets, particularly over a longer period of time. And that's why we use rolling returns. Rolling returns take into account the fact that market cycles, whether bull markets or bear markets, they do tend to transcend month end or year end or quarter end arbitrary dates. In fact, rolling returns are what are used when we do random simulations for our clients in order to try to understand what is the most conservative strategy that you can afford. And I'd like to conclude by saying that if we're going to use macroeconomics as a conversation starter, as a place to understand what's going on in the world, let's use the macroeconomic tools that are the most reliable. Let's use the ones that tell the story fully and accurately as possible in the context of your situation, your values, your aspirations. And the same thing is true when we apply that theory to the actual application of investment strategies, asset class selection, calculating risk capacity, calculating spending capacity, and being flexible with strategy. And that is my conclusion for today. Gross output and market inputs. Thank you for joining me.